Hello and welcome to Investing Confidential. Well, inflation expectations, right? That's what everyone's talking about. That's what has driven the market. We spoke about this a few weeks ago. Inflation is coming down. It's not coming down to the Fed's target, but it is coming down. But what are the expectations? Okay. Is inflation under control? Does inflation matter anymore relative to the bond yields? Is there a greater danger ahead? This is what we're going to discuss today. Also talking about the U.S. recession, because I think I mentioned about regionalized recessions. But let's start with last week's inflation report, because obviously that's been driving the market over the last 5 or 6 trading sessions. Everyone's celebrating, right? We knew this was going to happen. That eventually inflation, the headline number was going to come off. But I mean, everyone's celebrating without looking at the big picture. I mean, no one looks at the data. Everyone looks at the people. People look at the headline without reading the story. So let's look at it. Okay, so here is the data itself. Okay, this comes right from the Bureau of Labor Statistics. Okay, so yes, from May to June, right? Everyone's so short-term orientated. From May to June, inflation did come off. Okay, but it's still relatively elevated. If you factor in that from April to May, energy prices, got pummeled. Okay, sure, you got May to June. I mean, all this is sort of month-to-month short-term thinking. But the reality is, look at crude prices now. Okay, they broke the downtrend. Crude prices are going higher. Okay, just today, you had news out of Russia that you have spiked up grain prices globally. Okay, now the Fed is looking at all this data, and especially wages. Right, wages are what the Fed is really worried about. Okay, here is wage growth. Wage growth is higher, especially if you look at it over the last 7 to 10 years, which I think the Fed does. Right, they remember we had this long period of below 2% inflation, and that's just why the Fed's target is 2%. Okay, doesn't look at the fact that over a 30-year period we had inflation at around 3%. No, well, 3 to 4%, maybe a little higher. We're down at this very low inflationary. We had a very low inflation for a long period of time, artificial, obviously, because of the lowering of rates and everything else. And now we've got wages are spiking. Okay, and now wages, obviously, in a 1 year out of an election, wages are not going to come down. They're going to go up. This is why people are scratching their head when you see the forecast is looking at the Fed raising the next meeting, and they're probably going to raise 25 basis points unless something crazy happens. Okay, and this is why also rates are not coming in. So let me explain something about the Fed. Okay, the Fed has a 2% target, and I should have probably done this earlier, but this is I'm assuming that this is a rolling number. It's not an exact 2%. It's a rolling number, so it's an average over a 12-month basis on an annualized basis. Currently, U.S. inflation in a 3-year annualized basis is running above 3%, 3.5%. Okay, no one knows what the Fed's looking at, whether it's 1 year rolling, 3-year rolling, 5-year rolling. They don't tell you that. Okay, but you are still way above this 2% target. Okay, and this is what the Fed is looking at. They're getting close, but they know if they don't continue on this path, that's why they're not going to achieve 2%. This is why the Fed has indicated we're going to have rates higher for longer. Okay, the Fed can wait it out, higher for longer. So for investors, the question is, will rates stay higher? Okay, we know that inflation is going to be a little sticky. It's probably not going to get down to this 2% annualized target for quite some time. But what about interest rates? Because even though we've seen inflation come off, interest rates have actually gone up. Okay, will rates come down with inflation? And I'll tell you, no, they're not going to come down with inflation, because one of the problems is, again, bonds are a pricing mechanism. Okay, so there's a supply-demand mechanism. We know that there's more supply coming out. Okay, but foreigners are not buying their bonds like they used to. Okay, the two big buyers were the Chinese and the Japanese. The Chinese, as we saw previously, they're not buying any bonds right now. They've lowered their appetite for bonds, U.S. bonds, quite substantially. And now As I'll show you in a few minutes, the Japanese, it's also going the other way. So as we talked about, it's not to really worry about, but it is, okay? It's not till it is, okay? And this is why we have this financial repression, which you're going to hear about more often, which I mentioned a few videos ago. Look what it is. It's a government forcing itself and local institutions like you've had in Japan for some time to buy local bonds, okay? And this is what's happening today. But let's go back to inflation. Inflation globally is still a big issue. Okay, if you look at inflation in Europe, it's a major issue. Okay, here's Japan, for example. I mean, they've got a serious problem. Japan's in trouble, folks, from a standpoint of policy. Okay, policy. And this is going to have negative impact. Japan is going to have to change their policy, which is going to accelerate the money coming out of the US back into the local market, because real rates are going to be much higher than even they are here for Japanese institutions. That's going to be a problem for rates in the US. Okay, the buyers are gone. And then look at commodities. Okay, here we got olive oil. Okay, something people use every day. Okay, here's crude oil. Okay, crude oil breaking the downtrend. Then we got hogs, pork prices spiking. Then we got cotton. Okay, and what this is telling you, okay, that the real issue is coming down the line. Okay, we discussed this many months ago. The real issue is the US dollar, folks. Okay, the US dollar is in danger, and the US dollar has broken the uptrend. It's now heading lower. No one's talking about it. Okay, remember, the strong US dollar was a problem for the market, but I mentioned this many months ago. The biggest danger we have is deflation, is the US dollar getting so weak. Okay, because it does things that people don't understand. Okay, and you have to focus on this weak dollar, because the weak dollar is inflationary, and it's going to keep inflation sticky, and it's going to keep bond yields higher. Okay, this is the worst case. Here we have metals index moving higher. This is also due to the weak dollar. So these type of commodities that we're seeing, olive oil, crude oil, metals, maybe not crude oil, but metals, hogs, this is not in the CPI. Okay, the CPI changes very often, and usually changes because you've got different governments coming in. The basket always changes. Okay, so it's a problem, and the CPI itself is an index, and it's manipulated. So all of these things that are happening, because that are beginning to happen now with the weak dollar, meaning commodity price go up, these are all inflationary, very inflationary, and they stick. They stick. Okay, and you're not going to see it, but what you're going to scratch your head about and say, okay, inflation is going down. Why aren't mortgage rates going down? Why aren't interest rates going down? Because, folks, deflation is coming. Okay, and this is the worst case scenario. Over time, very bad for stocks. This was the problem in the 70s. We had stagflation. Okay, we had a kind of inflation, and we had low growth. But in the end, what it was deflation. Deflation, which killed the market, killed real estate, and killed everything else. Okay, so the pandemic causes this distortion in stocks, distortion in everything, and everything's coming back. Everything's going to revert back. I still believe, I know it sounds crazy, but I still believe that stocks are going to revert back to right before the pandemic at some point. I don't know the timing, but the implications for the stock market for deflation is very negative. Okay, now in the short term, look, we know the market's going higher. Okay, it's poised to go higher. Everyone's getting bullish, which is a red flag. But in the short term, here's what we got. You had inflation coming down, and you had the bank earnings. Okay, the big banks showed better numbers. Why? Net interest margin. Again, net interest margin. The difference between what they pay on deposits and what they lend and what they invest in. The banks, the large banks, which don't have to pay much in deposits, made a fortune. JP Morgan, for example, they made a fortune on the float. Okay, this is what they call the float. Now, the banks that have to increase rates to keep depositors are going to get crushed. These are the regional banks. Now, we haven't seen regional banks report yet, but when they do, it's going to be ugly. So one thing to know, look at State Street. State Street is kind of a regional bank, kind of a different, kind of a quirky kind of bank, but the bank got crushed because they had to pay higher deposit rates to keep depositors. And so what's happening is there's only a few banks benefiting from this. BlackRock being one of them. It's not a bank, but look at the amount of money going into BlackRock money market funds. Where's this money coming from? It's coming from banks. It comes from banks. Now BlackRock is showing these inflows. They're hiding their other problems because their other problems is that their other funds are not performing. Money's flowing out. But that's another story for another day. And as far as the banks are concerned, credit cards. They're making a fortune. Look at the balances on credit cards. They go higher. And by the way, this is mainly skewed toward younger people. Okay, younger people are borrowing money like never before to support their lifestyles. Obviously, that's the only reason I would think. And then you've got this other where these credit card rates, they're at the highest all time. They've never been high. Again, these are average rates of 22%. They have not been this high ever. So folks, don't live your life on credit card. This is going to come back to kill you because rates are not going down. You're not going to get relief. Okay? Because it doesn't matter about inflation. Inflation now is no longer going to be a market driver. Okay? I said it again. Will no longer be a market driver. But again, look at mortgage rates. They're going to stay high. They're going to stay. They'll come down, but they're going to stay high. And they're going to stay high until the real estate market begins to collapse, and then they'll go lower. So for now, all of these factors that we've been talking about are really bad. So you've got to focus on the economy, and you've got to start focusing on this deflation, a weaker dollar and deflation. These are the key. Okay, so I still believe a debt downgrade is in the works. I think that's going to be the acceleration of the dollar really getting killed, but we'll see. I mean, so far nothing, but I still believe it's going to happen. I think as I said, I think we've been in a recession. I think the problem is that living in New York, I think New York is in recession, Chicago, San Francisco for sure, LA, the big cities are in recession, but the rest of the country's holding in there. Here's Yellen, which has zero credibility, saying there's no recession on the works. I think she's completely wrong. Okay, you got Goldman Sachs, who's a shill for the government against other economists. Goldman, okay, these are inflation probability. Goldman's always wrong, by the way. I mean, every professional money manager knows that whatever Goldman says, you just fade it. So Goldman says there's only 30%, whatever they're saying, probability. Most economists saying 60%. I'll go with the trained economist rather than Goldman Sachs. Take the other side of that trade. And the market's still driven by tech. Okay. And here's the put call ratio. Everyone's got calls. The market's turned bullish. This is a red flag. Okay. Again, the timing uncertain, but everyone's turning bullish. Jim Cramer's bullish. All these people that you want to fade. So it's time to be very cautious. But if you don't want to be cautious, if you want to keep in the market, which over time says you should be, we talked about correlations. Okay, very simple on the S&P. This is the time. It's stocks, stock picking. You just can't buy an index anymore. You're not going to make money for a long period of time with indexes. You've got to be a stock picker. So enjoy the last of this rally. Earnings season is just underway. Okay, the banks were the first ones, and they're the ones who made the most money during this period. But remember, as always, guidance is the key. Watch for the guidance. I don't think guidance is going to be very good. So stay liquid. And for you investors, be careful out there.